Let's do it, folks. Good morning, one and all. Welcome to the Street Today here from Post 35 on the floor of the New York Stock Exchange. It is Thursday, the 2nd of February. Groundhog Day, indeed. It is an incredible movie. I know. Phil Connors, I'm JD Durkin. We're about an hour or so into the trading session. Stocks are trading. The Dow was down fractionally. Big pop so far for the S&P and the NASDAQ especially. My goodness here. As stocks, or rather as investors, are trying to digest everything we learned from the Federal Reserve. 25 basis points. That was the bet. That was the expectation. And that, in fact, was the conclusion, as we learned yesterday at 2 o'clock. All this while signaling more rate hikes were to come. But the Fed giving us some kind of sign of a change in the winds here, perhaps. Disinflation, the key word of the day. That word, disinflation, not deflation. That would be inflation fully reversing, but disinflation, which means inflation's still happening, it's just kind of happening slower. That word was used 13 times by Chairman Jay Powell at his press conference yesterday. Kind of what investors want to see across the major market indexes. You can't get everything you want, folks, but maybe just part of it. On the show this morning, we will be talking all about the Fed after the central bank raised interest rates by 25 bips in an effort to curb inflation. Plus, we will talk tech earnings as names like Apple, Amazon, and Google parent Alphabet gear up to release quarterly results after the bell today. And finally, we will bring you all of the details as, as Netflix now decides, oops, we actually want to crack down on password sharing. Never mind what we told you years ago. We actually now realize it's kind of bad for business, and now we're reversing course. We'll tell you everything you need to know. For more on those stories and so much more, let's bring in our very special guest, Bill Stone. Bill is Chief Investment Officer of the Glenview Trust Company. Hey, hey, Bill, good morning.
Good morning.
Your name is not Glenn. Glenview Trust Company is where you work. My apologies, Bill. Good morning. You can tell I've not yet had a ton of caffeine. I was up late rewatching Powell's press conference. But before we get into Fed specifically, give me some of your senses here. What are the main factors helping drive investor sentiment so far as the dust continues to settle a little bit after we finally, at long last, heard from Mr. Powell at length yesterday afternoon?
Well, I think a lot of it is the Fed. So you've got, some seemingly relief that they're not going to keep pressing quite as hard as people thought they would on higher rates. Also, I'd say what's really been priced into the market as well is that inflation is going to get under control. Timing is always unclear, but when you look through to break evens on Treasury inflation protected securities, other places, the market says, hey, we're going to get through this inflation problem. That just eases off a lot of worries. And I'd also say the last thing was, it had gotten so negative on kind of growth companies last year that I think that data didn't come out as bad as expected, or I should say company information didn't come out as bad as expected, company earnings, that I think it was, in some cases, just a relief rally. So it wasn't that sometimes I point at really good numbers with these companies. It's like, wow, it just didn't completely fall apart, and they're good businesses, and eventually they just got thrown away too much.
So some are saying, hey, folks, we're here. We made it. The bull market territory officially begins. Other people say, yeah, thank you, but no thank you. We're probably not there. Maybe it's just sort of a relief month instead of a series of temporary relief rallies. Where do you sit in this in terms of the intersection of the bull market versus bear market conversation? Where are we?
Yeah, I mean, I'm going to say I'd still be careful. It's, again, not that we're not positive in the long term, because I think valuations are reasonable. Again, a lot of companies being run very well. Profitability looks good, even though there's a squeeze on margins. But again, you can make a good case that those margins should start getting better, because I do think inflation is at least moving in the right direction. Again, when exactly it gets to where we'd like it to go is unclear, but moving in the right direction is something. The hard part is, like I mentioned earlier, if you already have it priced in that inflation is going to get under control, that's it's both a good thing and a risk, right? So suddenly you get some data that isn't as helpful, and you start to worry the Fed has to go back to pressing on rates going higher, longer. That becomes an issue. So, I think you're still in a place where you gotta stick to the fundamentals of looking at companies that can make it through kind of no matter what happens. Because I'd still say the economy looks like it's going to be bouncing along the bottom here, at least for the first part of this year.
I wonder if you're surprised, and I'm pulling up the number in front of me here right now. The S&P, as we're having this conversation, is at 4170. And I say it like that because you know what the guidance was from the Goldman Sachses of the world heading into the start of the new year. They said we're basically beginning the year at 4,000 and we're going to end the year at 4,000. Are you surprised to see, after a stronger than expected month, earnings season kind of hit or miss, news yesterday, that keyword disinflation used, are you surprised to see, at least as of right now, that we're pretty well north of the 4,100 level, and do you expect it to stay there?
Yeah, I mean, I said it in one sense. We came into the year actually fairly optimistic because our view was eventually the market was going to look past all these things and look to to earnings snapping back and all that. So we'll give ourselves credit for that. I would say I did not think it would snap back this quickly. Yeah, I mean, I didn't think essentially you turn the calendar and all of a sudden, because calendars really shouldn't mean anything in one sense, but yeah, I think it does argue that you, again, probably be a little careful, particularly some of the more speculative stuff that may have bounced. I'd be probably looking a little more, sideways at that. I think some of the high quality growth companies like a Meta, like an Amazon, those kind of things, while they may pull back, I'm not so much worried about those.
Well, I mean, on the one hand, yes, the calendar really shouldn't matter, but is there an argument to be made to say, all right, the end of December, we were going to have a lot of selling in parts that people could deduct those losses, right? We talk about tax loss harvesting a lot. It happens in crypto. It happens with a lot of these names and equities, Bill, where a lot of people were sitting there saying, my goodness, I took so many losses in 2022. For the love of God, make it stop. I just want to exit my positions here. And now, right, because there's plenty of components where that's advantageous for taxes for the last year, for 2022. But now they may be sitting there in January, because it is a new calendar year, and saying, all right, I actually kind of want to re-enter some of my positions that I sold off for taxes. Maybe there is something to be said about a change in the calendar leading to some of the buying, or are you not buying that particular argument?
No, I think you're right on with that part. I think that is one thing that I thought I was seeing in some of these stocks, where you just said you had people going, hey, I got tax losses. That's one thing. Two, just let the pain stop. So yes, I'm going to just sell this out essentially no matter what the price. And, that way I get that tax loss. And hopefully they were smart enough to move into an ETF or something that owned a lot of the same thing, or maybe something else in the same industry, to get the bounce, which is the things that we kind of did at the end of the year. But yeah, I actually do think you're right on that part. That is probably the one thing I'd say, particularly for a year like last year, where I think that's a completely reasonable, and I think that, at least looking at the evidence, I think that happened.
All right, let's talk about the Fed in slightly greater detail here, or much greater detail. Why not? It's a Thursday. Let's have some fun here. 25 basis points was the expectation. That is, in fact, what we got. It's the 8th increase, I believe, from the central bank. And the Fed maintains that ongoing rate increases are appropriate. I'm sure you watched closely to everything Chairman Powell had to say, both in his scripted remarks as well as for the Q&A. We always tell folks, watch the Q&A. There's a lot that you learn. What are some of your biggest takeaways from yesterday's press conference?
So I think, and I'd argue most of the market was thinking this the way that I was, which was they thought Powell was going to push back harder against the market having priced in prior to the meeting, actually a cut sometime in late 2023, or late this year, I should say now. But what was interesting is, while, you kind of talked about it, he still talked about more hikes to come, but he didn't push back as hard. It was kind of an interesting nuance where he didn't push back nearly as hard as I expected him to. And I think that's what then gave the markets the green light to say, hey, you know what? Forget the one cut. We might get 2 cuts in 2023. And to me, that's the nuance different. Is he admitted, you hit on it, right? Is now, we may see that disinflation. And before, they were so adamant about crushing inflation that was enough of just a tone shift. And again, not pushing back quite as hard as I think most of us expected. And there you go. I mean, that was the green light.
Is Bill Stone in the camp that we are actually going to see a rate cut? I'm talking the calendar year for 2023, not maintenance, not get to 5 and change or whatever it is and hold. Are you in the camp that we'll actually see a cut, at least one?
I am, and I'll tell you why, because I think we're going to have a recession at some point in 2023. I mean, you can never be sure of these things, but I try and go with where the data points, which is when you get essentially every yield curve inverted. They have had a phenomenally good track record. Could they be wrong? They could. Could we just skitter across the bottom and not go into recession? It could happen. But I think that's what opens the door to the cuts, because that's when the Fed would do it if they were going to. So not necessarily good news. And I'm still mindful of the fact that households are in great order. Powell talked about it in his conference. The job market has been amazingly resilient in the face of all these hikes.
Yeah, I was personally a little surprised. Maybe I should not have been, but it was kind of interesting that he even referenced the JOLTS data. And I'm thinking to myself, the second he said, I'm like, didn't that just come out a few hours ago? And it did, but I think that kind of shows that he was ready to kind of come out and take to the podium and really at least indicate here, Bill, that he was taking into consideration the most up-to-date information to make his decision. Also said, obviously, this was unanimous with all of the Fed governors. And keeping in mind, you got new names in there, right? The Board of Governors is different. The regional Fed names, some of them are different here, but they're still unanimous that this was the step in the right direction. Was there anything else that he had said that kind of caught you by surprise, or maybe you weren't expecting, I wonder?
No, I mean, I think you make a great point with the job market. So to me, the job market is, and that's why, it'll get interesting tomorrow, because, again, the job market's crucial. The way the Fed's looking at it is they essentially, while they don't like to say it this bluntly, I'm going to say it bluntly, they know or believe that they need unemployment to move up for inflation to really, or particularly the services inflation, to really start to move into disinflation. And that's why you hear them, I think, like you mentioned, watching the most up-to-date data. And we just haven't seen a crack in it yet. So that's why I think that'll be important to, and I think everybody kind of knows that. But it certainly shows you what's on the Fed's radar.
And I also wonder, it's just sort of interesting with a week like this. Obviously, earnings is top of mind, but so is Powell. And this time tomorrow, the thing that will be top of mind is the new jobs numbers. It's just kind of interesting. We get the FOMC decision 48 hours or so, less than that, before the jobs number, because right now that unemployment number, it's pretty stubborn. I mean, listen, it's in any normal economy, any normal political cycle, everyone would say, oh, wow, 3.5% unemployment. Folks, we did it. We're doing a great job. But as you correctly say there, the goals of the central bank are kind of counterintuitive. And I wonder kind of what that number may look like into tomorrow. Before we move on here, any kind of expectation maybe specifically for that jobs figure tomorrow? Could be the top line number. It could be unemployment, which we know the Fed is watching very closely.
I mean, it looks like it should hold in there, all the kind of subcomponents, even though we're seeing, like I said, we're seeing the economy, at least according to the thing I'm looking at, again, kind of weakening. And even the fourth quarter GDP numbers that we got recently, the headline looked a lot better than the underneath, which really argues for a slow start to this year. But, that being said, so far anyway, and I know that's the thing about labor markets, is they tend to be lagging indicators. They haven't really given up anything. I think it's, at least from our standpoint of, running a business here, we're seeing a little more interest in, say, our job postings that we have out and things like that. That certainly is a change, but it's not, a sea change. So I expect it'll still hold in there, especially when you look at initial jobless claims not showing any signs of a big, decline. I mean, I should say a big increase that would.
Sure. Yeah, I did not mean to cut off your final word
there.
No. But you raised a really interesting point there. You said about your own job postings. And that's what I want to ask you about, because we learned from the JOLTS data yesterday that the levels are now topping 11 million, more than 11 million unfilled jobs, right? The most frequently cited statistic is that for every one person looking for work, you got now 2 jobs-ish that are open. But since you mentioned your own company's job postings, and this is part of the phenomenon that some critics have argued, they say if you have a job posting, you may have posted a job out there, let's say 8 months ago, that you'd like to fill with the perfect candidate. You would like to have this perfect unicorn of a candidate come along and fill. But if not, you don't necessarily need to fill that job. You could still kind of continue to do business as usual. Meanwhile, that number would still show up in the JOLTS data as being an unfilled job. Now, I don't mean to put you on the spot and talk to me personally about the situation of you and your company, but is that something that you're experiencing that may actually kind of skew that JOLTS data and therefore kind of skew part of what the Fed is looking at?
Yeah, well, I'll give you two answers. So one is I think you're right in terms of the numbers. That certainly some of that's in there. I mean, having worked at a big company before, not, in a big corporation, you have this inertia and you just have these job openings that sit out there. You're right. In our case, we just happen to be lucky enough to continue to grow. So we're legit looking for people and that we really are going to fill these in the short run. But I think you're right that you have to be careful with that JOLTS number, not to read too much into it. Plus, it's such a lag. So I don't get real crazy, honestly, about that JOLTS number. I kind of almost take, and again, it's always dangerous to look at our own situation. But like I said, the way we saw it was, back last year when we post job openings, we wouldn't necessarily get a lot of people putting in for them. Now we're getting significant amount of incoming applicants. So I do think something has changed. So, maybe on the margin, you're seeing a little bit of loosening of the job market.
That's a really good perspective. I appreciate that. And of course, all this feeds directly into wages and to what degree any company, I'm not citing yours specifically here, but any company needs to increase wages to incentivize good candidates to getting off the sidelines, right? We've had this running joke for a while. It's like, where are the workers? Where are people if we have all these job openings? But I think that JOLTS data should have a little bit of a grain of salt sometimes. Before we pivot here to earnings, anything else that you would want to stress in terms of the labor market, in terms of jobs, either the data we got yesterday and what you think it may mean for future Fed considerations? Because before long, we're going to be all eyes on Mr. Powell again in terms of what happens next.
Yeah, and I think you can highly expect a hike again in March, because I just don't think the data is going to get weak enough. Speaking of the jobs or even the inflation numbers, they're just not going to get down quick enough. They might continue to move in. I'm going to put in air quotes, the right direction. So just expect another hike. Then it gets more interesting. I think after the next meeting, then it'll get more interesting as to the path.
That meeting is scheduled for March 20. Do I have this right? 21st. And let me see, 21st, 22nd. Yeah, so the decision there would be on the 22nd. Pardon me, 21st, 22nd, and then your expectation there is for another 25. I'd have to imagine.
Yes, I think that's almost for sure.
Okay, absolutely. All right, I appreciate that perspective. Okay, while I have you, let's talk earnings here. Hello, folks. Who saw this one coming? Meta, the story of the day. Not something we've said very often for quite some time, but a huge Q4 beat on revenue. Promises here to scale back spending. That's been a big concern. You didn't have this big pivot away from the metaverse the way that I know a lot of investors wanted to say, who've been scratching their heads for a while saying, Zuckerberg, what are you doing, man? Right? We didn't quite get all that, but the $40 billion stock buyback announcement is now the second highest out of any company other than Chevron, which we talked a lot about last week. What are some of your big takeaways from this report? It popped 20% in pre-market, having a big day.
Yeah, so I'll just mention we own it, and we actually bought more late in the year, so this is a good day for us. Yeah, my takeaways are, thank goodness, right? Our thesis was it was just too cheap, but the danger was, they just would continue to spend maybe way too much on the metaverse. Unclear, right, if it was going to pay off. We just thought the most attractive part of it is, it's really an advertising business, right? And as long as there's more and more eyeballs going to that business, it is an extremely attractive and profitable business. This quarter showed up, and that's why I think you just see this massive relief rally, because you mentioned it. One is they cut back a bit on the capital spending on the metaverse. Two, you didn't mention this, but they were able to convert more. One of the big issues was that the changes with the Apple privacy policies didn't allow them to know as well what was going on the iPhones. They clearly have made some headway there, which means advertisers will be willing to pay more for those ads if they have more transparency. That was a great news item. Lastly, the eyeballs looking at the different social media sites that Meta owns went up again. So while you can say, hey, the macro is not as good, because usually when you get a slower economy, there's slower ad growth. That's all true. But the long-term value of the business is what you really care about if you're investing in these kind of things.
And I'd have to imagine, to the point of advertisers, if they tighten their belts, it's not necessarily, I don't think that they scale back spending across the board in a uniform way. I think oftentimes advertisers will look at their kind of less reliable or less tested options, and maybe in this environment that's a TikTok or a Snap, some of these other kind of tech names that are in there, and saying that's where we scale back, but we're not going to scale back from Facebook, or we're certainly going to scale back from Instagram, right? I mean, if these are the big proven players that Meta has under in its toolbox there, I feel like advertisers, this whole concern about a digital ad slowdown may not really apply necessarily to a Meta. And I wonder if you see it the same way, of course, keeping in mind that you hold it, and congrats on your big morning. I'm sure you're enjoying it.
Thanks. Yes. Yeah, well, because it was painful there for a while, so let's not, not say anything else. So it's more relief, but yeah, so you're right. I mean, I do think still, hey, if the economy gets bad enough, the advertising will get hit. But the beauty of it is, you're right. I mean, I think the secular move is toward online advertising more. You can get obviously much more targeted. And as I mentioned, when you have a situation where they seem to be doing a better job of being able to prove better that these ads are translating into sales that they were having trouble with before on the Apple devices, that's just even better news, right? I mean, that just makes the case even stronger.
Absolutely. Okay, well, we're having such a good conversation here on Meta. I could truly do this conversation with you for quite some time, but I do want to pivot here and quickly get your sense on what we may hear after the bell today. Apple, Amazon, Alphabet. I can't even say the three names without smiling because it's that big of a day. What are some of the main points you will be on the lookout for, Bill?
Yeah, I mean, I think, in terms of, it'll be interesting. Another one, while we own Amazon and Alphabet, Amazon to me is one we've been very positive on, despite the fact that the stock has gotten hit pretty hard. Our thesis has been, like I mentioned, we expect a tough economy this year, but we like companies that, clearly I don't have to worry about them making it through. Two, there's probably less competition by the time they get done with things. So, I'll just be looking to just see, they may bring more to the bottom line because they are doing some cost cuts, but big picture for me is just to continue to try and gauge whether they're running the business right. I'm okay with them investing more in the business if they think that long run they're going to be able to take advantage of it. And frankly, Amazon has done that historically. So I probably give them more room. And you'd probably say the same thing, honestly, about Alphabet. Again, we'll look at their ad business and so forth. That'll be a good thing to look at as well.
Yeah, absolutely. I always like to take a look at market cap and all this. Apple's still sitting pretty, the number one spot, $2.377 trillion in market cap, above Microsoft and Saudi Aramco. Apple, of course, biggest market cap in the world. And these other names, no slouches either, and we will certainly follow all that. Okay, a couple quick, more general investing questions to wrap things up, and thank you again for how generous you've been with your time. Stocks continue to remain in this kind of wonky territory. Do you view this as a good buying opportunity for people who are wondering, where's the dip?
Well, I mean, you're still down from the low, so I'm always careful. Who knows in the short run? But long run, you look at valuations are at least reasonable. And I do think, still, while a lot of these companies have bounced off their lows, they haven't necessarily run away. I say to people, just make sure you're in, I call them higher quality, but companies that you're not going to have to worry about if we go into recession. And what I mean by not worry about doesn't mean the stock prices don't go down. It just means you don't have to worry about them going belly up, which again, I kind of say, like an Amazon, a Meta, I'm a big Anheuser-Busch fan, because alcohol consumption just does not decline during recessions, things like that. Extremely profitable companies that also just generally don't see a lot of pressure on the revenue line, or at least relatively speaking.
What are some of your tried and true investing tips that you are carrying into this new year?
I mean, I think I think a lot of what we saw last year, I think will continue over, which is focusing on the fundamentals and looking at it as, I always try and tell people, we look at it as a company, not as a stock to trade, which I think helps you get through the tough times. It's kind of like I talked about with Meta, right? Is if you sit back and go, I know they're killing the stock, but when I go back and look at their business, it is just an awesome business. I see the challenges, I see those things, But if they don't even need at a certain price, or at the price it certainly went to, they didn't even need to get it back to as good as it was. They only needed to get some portion of near where it was, or maybe even not that near, and I still win, right? And that's the way I think is a good way to look. It allows you to hold companies through more difficult times and, knock on wood, see them pay off. Also hopefully helps you avoid some that, maybe the risk reward just isn't so good, where you say, I'm kind of worried that this company, frankly, might not even make it. That's an extreme, but that's certainly for some of those kind of more, I'll say meme stocks and things. I hate to even mention meme stocks. I get hate mail if I do, but some of those kind of things, are too much risk for reward for me anyway.
Yeah, you're not kidding, and nor are you alone in that. Finally, what are some of the most attractive sectors on the street right now to you?
I mean, I think, we've seen the bounce in technology. I wouldn't say it overall, but, I think that's technology is going to be a growth area. It may have their bounces. Hard to pick a specific area in the sense that I think there's interesting, spots. I'm kind of in the mode of the market overall doesn't necessarily point you somewhere. You really have to dig into specific companies a little bit more. There's no one thing to say, like all the staples are necessarily cheap or something like that. I mean, maybe you could argue we're not a big energy owner. We own some, but that's a spot that at least if it holds up anywhere near in terms of the earnings, that looks pretty attractive. And certainly, Warren Buffett and Berkshire Hathaway think so. So you're not in bad company there.
Absolutely. Okay, my special thanks there to our special guest, Bill Stone, Chief Investment Officer of the Glenview Trust Company. My man, this was an awesome conversation. I really appreciate everything. Thanks for joining us today.
Hey, thanks for having me. I had fun.
Absolutely. We'll do it again soon. And enjoy Earnings Palooza after the bell today. All right, folks, coming up here on the show, we will be bringing you all of the latest headlines on ChatGPT's new subscription service. Yes, it's growing. It's metastasizing. Plus, latest details on Netflix's password sharing crackdown. I can't help but laugh when I read the headline. But first, I sat down with several experts to discuss their tried and true investing tips. Take a look.
Put a plan in place and you stick with it because the moves are unpredictable. We do think the bull market will return. We just don't know when. Timing it can be a little difficult. Try not to get too cute. If you want to get into this market, we would do it gradually. I would gradually deploy to your own risk tolerance level, not throw it all in one day.
Charting matters. Having some kind of a understanding of the major moving averages that all institutional investors use. So it would be the 50 and the 200-day moving average, or the 50 and the 200-week moving average. Because if you look classically over the last couple of years, when we broke those, that's when we saw the big decline in 2022. And as we're clearing them is where we're seeing more buying. So I think it's good to have some kind of a navigation system, if you will.
I think the most important thing for individual investors right now, for the first time in nearly a decade, you have the ability to not just look at equities, but fixed income. You're actually getting a return. You haven't been paid in fixed income or that 40% of your 60-40 portfolio in a while. So pay attention to that. And there's some great opportunities out there.
I'm telling investors, make sure you're investing in things that you're fairly confident will continue to pay a yield and grow that yield, to have the business model and the cash flow generation ability to grow that yield over time. And some of the places we're seeing that right now, even though you'd argue that many energy companies long-term are value-destroying business models, I think energy is still in the sweet spot. I think cash flow for energy companies is going to continue to be very strong in the kind of economic environment we're predicting.
All right, my special thanks there to each and every one of those individuals for their tried and true investing tips. Let's now get you caught up on some of the biggest business headlines that we are following for you at TheStreet Today. First up, OpenAI, the company behind ChatGPT, unveiling a brand new subscription service, ChatGPT Plus. Yeah, that's true. The premium tier will run users around $20 a month and will offer priority access to the chatbot even during peak hours. Subscribers will also receive faster responses and access to any new features and improvements made within the tool. This launch comes just a few weeks after Microsoft announced a huge investment into the company, and just 2 months after the company officially launched to the public. The chatbot quickly went viral for its impressive ability to write poems essays, even pass high-level exams. For all I know, it could also raise interest rates on its own. Watch out, Jay Powell, it's coming for your job. But if you're not ready to commit to paying for the new look tool, the company will still offer. This whole thing is so silly. The company will still offer its standard no-cost version if you need it to write your poems or whatever it is. I'm sure it's a cool tool. I just haven't used it myself. I'm not, no shade on ChatGPT. I'm sure it's amazing. It's just, this thing's everywhere. All right, next up, and what is bound to cause controversy, Netflix moving forward with its announced plans to crack down on password sharing. Starting next month, Netflix will no longer allow users to share passwords with anyone outside of their immediate household. As part of the new maneuver, Netflix will require users to identify a primary location for their account, and only users within that household will have access. Anyone who uses the account outside of the primary location will need to sign into the household's Wi-Fi once every 31 days. All of this despite the fact that Netflix famously tweeted, quote, "Love is sharing a password." To be fair, that was back in 2017. They are getting buried for that tweet today, you can imagine. According to Netflix, over 100 million households engaged in account sharing, which the company said, quote, undermined its business and ability to make improvements. Move over to Netflix and chill. It's now Netflix and don't you dare steal my password. All right, finally, let's talk big oil profits, of course, because that's exactly what the companies are doing. They are raking in record profits for the fourth quarter, coming in well over last year's highs. Shell, which reported earnings earlier today, brought in over $41 billion, a $10 billion jump from the company's previous record in 2008. And yes, I did say billion with a B. Exxon and Chevron also reporting their biggest profits earlier this week, raking in 55 and 36 billion bucks respectively. Industry experts have predicted that the oil giants would bring in a combined total of $190 billion in profit. Yes, I did say that. After a year of soaring oil and gas prices amid the war in Ukraine. All this comes with a heavy heaping of controversy, however, as big oil continues to be called out for taking advantage of the skyrocketing oil and gas prices and refusing to lower gas prices for U.S. consumers. The White House has been paying attention, in case you don't know. Last June, President Joe Biden called out Exxon for making, quote, more money than God. That's what the president, that's not my quote, folks. That's what Joe Biden said, more money than God. And on that note, that's going to do it for The Street today. Thank you again to our very special guest of the morning, Bill Stone, Chief Investment Officer of the Glenview Trust Company, for taking the time to join us this morning. Stick with TheStreet.com for more on these and all of the major market stories that matter to you, and we will see you tomorrow.